Let's talk about Warren Buffett. The guy's an investing legend, right? A billionaire who really knows how to pick winners. But there's this one huge, headline-making asset that he just will not touch. And yep, that's Bitcoin.
So you've got to ask yourself, why? Why is the Oracle of Omaha, a guy whose strategies are studied worldwide, so against what a lot of people are calling digital gold? Well, the answer tells you everything you need to know about his entire philosophy.
Okay, so to crack this code, to figure out his beef with Bitcoin, we have to get inside his head. We need to understand the one simple core rule that guides every single investment he makes. It sounds easy, but trust me, it's the key to the whole thing.
Buffett is all about what he calls productive assets. Here's a great way to think about it. Picture a farm. A farm is amazing because it's not just a piece of land sitting there. Nope, it's working for you, churning out corn or wheat or whatever year after year. It's actually generating new value all by itself.
Now here's what's so crucial to understand about his thinking. He's not buying that farm because he's gambling on selling the land to someone else for more money later. No way. He's buying it for the stuff it produces, the crops. That's something real, something tangible he can sell for profit consistently. For Buffett, that is real value.
Okay, so now let's look at the flip side. Let's talk about the other kind of asset, the kind Buffett stays a mile away from. This is the category where he puts Bitcoin. And once you get this difference, the whole puzzle just clicks into place.
And boom, here's the difference in black and white. A farm is a business, right? It makes things. But gold, and in Buffett's mind, Bitcoin, well, they just sit there. They don't make anything. They don't produce dividends. The only way you make money is by hoping, really hoping, that somebody else will come along and pay you more for it than you paid.
You know, this whole strategy, buying something that produces nothing, just so you can sell it for more, actually has a famous name in the world of economics. It's called the greater fool theory. It's kind of harsh, but the idea is simple. The game isn't about how much the thing is actually worth. The game is about finding someone, a greater fool, who's willing to pay an even higher price because they think they can find an even greater fool after them.
Just think of it like a big game of hot potato with money. You buy, say, a coin. That coin doesn't pay you rent, it doesn't give you interest, it does nothing. You just hold on, hoping the price goes up so you can toss it to the next player for a profit. And now they're holding the potato, hoping to do the exact same thing. It's just a chain of people betting on the next person's bet.
Now, you might think this is some new, modern idea, but this exact game has played out before, spectacularly. For one of the most famous examples ever, we've got to jump in a time machine and go all the way back to the 1600s.
So back in the 1600s in the Netherlands, tulips were this new, exotic, beautiful thing. But pretty soon, people went crazy. They stopped caring about the flowers themselves and only cared that the price of the bulbs was going through the roof. People were trading them like they were stocks. And at the absolute peak of this frenzy, well, the price was just insane.
How insane, you ask? Get ready for this. At the height of what we now call tulip mania, a single tulip bulb was worth the equivalent of over 23 million Thai baht. That's about $750,000 US for a plant bulb. Obviously, that couldn't last, and it didn't. Eventually, everyone just kind of woke up at the same time and realized the obvious truth. The whole thing crashed because the thing they were trading, well, it didn't have any real productive value. It didn't make you money. It didn't do anything. At the end of the day, it was just a flower.
And this is the key. For Buffett, when he looks at any asset that doesn't produce something on its own, he sees the ghost of tulip mania. He sees a game that depends entirely on finding the next person willing to pay a higher price, not on any real fundamental value being created.
So, what's the big lesson here for us? What's the takeaway from all this? Well, Buffett's advice is actually pretty simple and straightforward, even if it isn't as flashy as all the crypto hype.
His advice is this: stay within your circle of competence. It's a fancy way of saying stick to what you know. Buffett buys Coca-Cola and Apple because he understands deeply how those businesses make money. And he's totally honest about it. He says he just doesn't get Bitcoin.
So let's be super clear. This isn't about him thinking the technology is bad. He flat out admits he doesn't understand it. It's all about him sticking to his tried and true system. Invest in businesses that are predictable and productive. And hey, it's a system that's made him one of the wealthiest people on the planet, so it's kind of hard to argue with.
And so his final warning, which brings us right back to that history lesson, is simple and powerful. He's basically saying, don't sell your house and car to go buy tulips. Don't bet your future on something where the value only comes from the hope that the next person will pay more.
because you just never know when everyone will decide they don't value tulips anymore.
And that really leaves us with the one big question we should ask about our own investments. When you look at what you own, can you honestly say, have you bought a productive farm or have you bought a really, really expensive tulip?